this month's market update. I'm joined by KC Lowe, Senior Consultant with Frontier. Hi there, KC.
Hi, Wayne.
Well, let's get straight into the Federal Reserve in the USA. A bit of movement again in fairly quick succession on interest rates.
Yes, that's right, Wayne. So the US Federal Reserve have raised rates again, this time by 0.5%, so 50 basis points. So the US cash rate is now sitting in the range of 0.75 to 1%. So as you say, it's the second increase and quite a large amount. So by 0.5% rather than the usual 0.25% increases. In addition to that, though, they've also announced that they'll start to reduce their purchases of securities, so otherwise known as reducing the size of the balance sheet. This has been an increase, and what we're seeing is that in terms of this announcement, Jerome Powell, the US Federal Reserve Chair, have also said that they aren't actively considering a 75 basis points increase in interest rates going forward, but it is very likely, they said, that there'll be more 0.5% increase to come in the upcoming meetings. So that's something to watch out for. And as a result, market expectations on the US cash rate has moved. So expectation is now for the US cash rate to finish at about 2.5% by end of the year. So quite a rapid increase there.
Yes, it is.
And then what the US Federal Reserve is expecting this to do is to slow down US household demand and also the US housing market. And we're already seeing signs of this start to flow through when as you can see in this chart, in terms of the US 30-year fixed rate mortgage rate, that has increased sharply in the last few weeks and months as a result of these increase in interest rate by the US Federal Reserve. Now, why is the Federal Reserve doing this? Well, one thing is to slow down demand, but the main thing is that they are trying to slow down inflation over there. So if we look at the latest US inflation, it's at above 8%, so it's quite a high number there.
That is a high number, a little bit higher than we're experiencing in Australia, but inflation here rising as well, of course.
That's right, Wayne. So the March quarter inflation figure was also released recently in Australia. And what we're seeing is that, at least in the headline inflation number, we're traveling at 5.1% in terms of annualized inflation here. But what the Reserve Bank of Australia like to focus on is what they call the underlying inflation. So removing any items that move around quite a lot, or volatile items, they like to call it. So to do this, they look at what they call the trend mean inflation. So in terms of that, increasing by 3.7% on an annualized basis. And to give you some context in terms of 3.7%, it is above the Reserve Bank of Australia's 2 to 3% inflation target, but we've also haven't seen inflation at these levels since 2010 or so. So it's been more than a decade since inflation has been this high. And if we look down into the components of it, what we're seeing is it's the non-discretionary or the essential components of inflation that has increased a lot more than the discretionary components. So I'm talking about components like groceries, housing, fuel for transport, so the stuff that all household needs. So these components have been increasing a lot more than other components. In fact, if we look at the housing component in particular, what we're seeing is that the cost of new housing has increased quite rapidly, and that's because of the cost of inputs and materials have gone up because of a number of factors. And we're seeing that builders have been willing to pass that increase in cost on to the end buyers because housing demand has been so strong. So why has inflation been so high in Australia? Well, quite a number of factors has driven it. So in terms of global factors, we have lockdowns in China again. We also have the war in Ukraine. And then we have domestic factors such as the floods in New South Wales and Queensland. So all these factors have contributed to more supply chain disruption, which has caused our inflation to pick up.
So there's a lot there for the RBA to manage. We've seen a move from them in terms of interest rates recently.
Yes, so the Reserve Bank of Australia has increased interest rates. So they've increased it by 0.25%, so 25 basis points, and the cash rate is now at 0.35%. So it's been quite a while since they've increased interest rates, so it's quite a big deal for the market. But this was a lot more than what the market were expecting. So most people in the market was expecting either no rate hike or only a 0.15% increase at this meeting. So this has exceeded market expectations there. And what that has meant is that market expectations have had to adjust. And as you can see in the chart, that market expectations have moved up quite materially. It's now expecting the cash rate to end this year at about 3%. And you can see, compared to 3 months ago, expectation was only for the cash rate to end this year at 1%. So quite a big shift there, and something to watch out for. So why has the Reserve Bank of Australia increased interest rates? So the main reason is that inflation is increasing, but also the Reserve Bank believes now that there's evidence for wage growth to be sustainable, and the way they've gauged this is through their own interactions with businesses and industry, and also through business surveys which provide more up-to-date and high-frequency information. So that's something to watch out for. And the Reserve Bank have also mentioned that given where inflation's at and where wage growth is expected to be at, that further rate hikes are expected to come.
So certainly some key factors moving in a direction we haven't seen for a little while, and it would seem like we've got some more movement to come. So plenty for investors to consider and watch. Thank you, Casey, for that analysis, and thanks for watching this month's Market Update.